Most people think they are free because they can choose which brand of car to lease or which streaming service to watch. But if you are living paycheck to paycheck, chasing a lifestyle you can't afford to impress people you don't even like, you are a slave in a very expensive suit. As we sit here in 2026, the world is louder than it has ever been. Everyone is a genius in a bull market, and everyone is a victim in a crash. But the truth is, the market doesn't care about your feelings. It doesn't care about your political leanings or your social media followers. The market is a giant voting machine in the short run, but a weighing machine in the long run. And right now, the world is overweight on stupidity and underweight on rationality. I've lived through almost a century of human folly. I've seen men who were worth hundreds of millions lose it all because they couldn't stand to see their neighbor get rich faster than them. Envy is a giant killer. It's the only one of the 7 deadly sins that isn't any fun. Gluttony makes you feel full, lust is enjoyable, but envy just makes you miserable. If you want to be a successful investor, you must purge envy from your soul today. You must be willing to sit in a room and watch other people make easy money while you do absolutely nothing. Can you do that? Because if you can't, you shouldn't be in this game. Let's talk about Jacobi's inversion principle again, because clearly nobody is listening. If you want to help India, you don't ask, how can I help India? And you ask, what is doing the most damage to India and how can I stop it? Apply this to your bank account in 2026. Don't ask, how do I become a millionaire? Ask, what are the 3 things that will guaranteedly keep me broke? First, high-interest consumer debt. It's the financial equivalent of a terminal disease. Second, buying assets you don't understand because of FOMO. And third, associating with people who have low standards. Avoid those 3, and wealth will find you as a side effect of your discipline. You don't need to be a brilliant stock picker. You just need to be consistently less stupid than the other guy. Most of the smart people I know are busy trying to predict the unpredictable. They want to know where the S&P 500 will be on December 31st. I have no idea where it will be. Warren has no idea. Anyone who tells you they know is either lying to you or lying to themselves. What we do know is the quality of a business. We know if a company has a moat, a structural advantage, that protects it from competitors. In 2026, those moats are being tested by AI and global shifts. But some things never change. People will still need to eat. They will still need insurance. And they will still be driven by the same psychological triggers that drove the Romans 2,000 years ago. If you understand human nature, you have a map that never goes out of date. This brings me to the Lollapalooza Effect. It's my favorite concept because it's the most dangerous. It's what happens when you combine social proof, authority bias, and the incentive-caused bias. Think about the housing crisis of 2008. It wasn't just one thing. It was the bankers wanting bonuses, the neighbors buying 3 houses, and the ratings agencies saying it was all okay. In 2026, I see the same patterns emerging in different sectors. People are piling into hidden gems and disruptive tech without looking at the cash flow. Cash flow is the oxygen of a business. You can hold your breath for a while, but eventually you need to breathe or you die. I've always said that a great business is a forest that grows while you sleep. But you have to plant the right seeds. You can't plant a weed and expect an oak tree just because you gave it a fancy name like Web 3.0 or AI integrated ecosystem. You need to look at the return on invested capital. If a business earns 20% on capital over 30 years, you will end up with a massive fortune even if you pay a slightly high price. But if it earns 6% and you hold it for 40 years, you won't have much more than a pile of regrets. The 1% understand this. They don't look for action. They look for mispriced bets. They wait for the fat pitch. Ted Williams, the great hitter, used to wait for the ball to be in his sweet zone. If it wasn't there, he wouldn't swing even if the fans were screaming at him. That's investing. The stock market is a no-called strike game. You can stand at the plate for years and wait for the one perfect opportunity. The only way you lose is if you swing at a bad pitch because you got bored or impatient. Ultimately, your net worth will eventually reflect your character. If you are a person of low discipline, your money will migrate to someone with high discipline. That is the law of the financial jungle. So, as you go through your day, ask yourself, am I being a rational actor? Or am I a leaf blowing in the wind of public opinion? The Munger mindset isn't about a formula. It's about the courage to be lonely when you are right. and the humility to admit when you are wrong. In the next part of this series, I'm going to break down the specific sectors where I see the biggest moats for the next decade. But before we get to the what, you must master the how of thinking. Because without a disciplined mind, even the best stock tip in the world is just a grenade with the pin pulled out. A lot of people think they have to be brilliant to succeed. That's not true. If you have an IQ of 150 but you think it's 160, you're a disaster. If you have an IQ of 130 and you think it's 120, you're going to do quite well. Understanding the edge of your own competency is the most valuable knowledge you can possess. We don't try to be smart. We just try to avoid being stupid. And it's remarkable how much long-term advantage people like us have gotten by just being consistently not stupid. The 2026 economy will reward the patient and punish the impulsive. If you can't keep your head when everyone else is losing theirs, you don't belong in the market. You belong in a savings account earning a pittance. But if you can master these mental models, if you can wait for the fat pitch, then the world is your oyster. Discipline is the only bridge between goals and accomplishment. Build that bridge today. You have to remember that big money is not in the buying and the selling, but in the waiting. Waiting for the right opportunity, waiting for the right price, and then having the courage to bet heavy when the odds are in your favor. That is how fortunes are made. Not by frantic activity, but by calculated patience. If you can master the art of doing nothing when there is nothing to do, you have already won half the battle. This is the foundation of everything we will discuss. Master your mind, and you will master your money. If you've mastered your mind, you're ready to understand the moat. In the medieval times, a moat was a physical trench filled with water and crocodiles to keep the enemies out of the castle. In 2026, a business moat is a structural advantage. That makes it nearly impossible for a competitor to steal your customers. Most investors buy businesses that are nothing more than open fields. No walls, no protection, and no future. Look at a company like Costco. They have a moat built on a psychology of shared economies of scale. They aren't trying to gouge the customer. They are trying to pass every cent of savings back to the member. This creates a fanatical loyalty that no amount of advertising can buy. When you find a business like that, you don't trade it. You don't sell it because the stock price went up 10%. You hold it until the moat starts to dry up. And in my experience, a great moat can last much longer than the experts on Wall Street predict. The tragedy of modern investing is that everyone is looking for the next big thing while ignoring the current great thing. They want to find a company that might change the world in 10 years, but they ignore the company that is dominating the world right now. I've always preferred the certain to the possible. If a company has a dominant market share, a brand that people trust, and a management team that isn't insane, you have a winning hand. You don't need to overcomplicate it. We are entering an era in 2026 where artificial intelligence is being hailed as the ultimate disruptor. People are terrified that their favorite companies will be wiped out overnight. But you must ask, does this technology strengthen the moat or weaken it? For a company with a massive data advantage and deep customer relationships, AI is just a new tool to widen the trench. For a middleman who provides no real value, AI is the executioner. You must be able to distinguish between the two. If you've mastered your mind, you're ready to understand the moat. In the medieval times, a moat was a physical trench filled with water and crocodiles to keep the enemies out of the castle. In 2026, a business moat is a structural advantage that makes it nearly impossible for a competitor to steal your customers. Most investors buy businesses that are nothing more than open fields, no walls, no protection, and no future. Look at a company like Costco. They have a moat built on a psychology of shared economies of scale. They aren't trying to gouge the customer. They are trying to pass every cent of savings back to the member. This creates a fanatical loyalty that no amount of advertising can buy. When you find a business like that, you don't trade it. You don't sell it because the stock price went up 10%. You hold it until the moat starts to dry up. And in my experience, a great moat can last much longer than the experts on Wall Street predict. The tragedy of modern investing is that everyone is looking for the next big thing while ignoring the current great thing. They want to find a company that might change the world in 10 years, But they ignore the company that is dominating the world right now. I've always preferred the certain to the possible. If a company has a dominant market share, a brand that people trust, and a management team that isn't insane, you have a winning hand. You don't need to overcomplicate it. We are entering an era in 2026 where artificial intelligence is being hailed as the ultimate disruptor. People are terrified that their favorite companies will be wiped out overnight. But you must ask, does this technology strengthen the moat or weaken it? For a company with a massive data advantage and deep customer relationships, AI is just a new tool to widen the trench. For a middleman who provides no real value, AI is the executioner. You must be able to distinguish between the two. I want to talk about the concept of cannibalism in business, not the literal kind, but share buybacks. When a great business with a deep moat uses its excess cash to buy back its own shares at a reasonable price, it is performing a miracle for the remaining shareholders. Your slice of the pizza gets bigger without you having to pay for another topping. This is the secret sauce of Berkshire Hathaway. We looked for businesses that were so good they didn't know what to do with all the cash. So they gave it back to us by shrinking the share count. But beware of the reverse. Beware of companies that issue shares like they are printing flyers for a nightclub. Dilution is the silent killer of wealth. If you own a business that is constantly asking for more capital just to stay alive, you aren't an investor. You are a philanthropist. And the stock market is a very poor place to practice philanthropy. To succeed in the next decade, you must become a collector of moats. You want a portfolio that looks like a map of invincible fortresses. You want the utility that everyone must use, the brand that everyone must wear, and the system that everyone must rely on. This requires patience that borders on boredom. If you aren't bored while you are investing, you are probably gambling. High-quality investing is like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. If you want to be rich, stay at home and study annual reports. The 2026 market will have periods of extreme irrationality. Prices will deviate wildly from value. This is your greatest opportunity. Ben Graham, my mentor, talked about Mr. Market. Some days he's manic and offers you a price that is absurdly high. Other days he's depressed and offers you a price that is a gift. Your job is not to be influenced by his mood, but to take advantage of it. You need the temperament to say no 1,000 times so that you can say yes once with total conviction. Character is destiny in this business. If you can't handle a 50% drop in your portfolio without panicking, you shouldn't own stocks. In fact, you should welcome the drop because it allows you to buy more of those invincible fortresses at a discount. But you can only do that if you have dry powder, cash on the sidelines. The man who is fully invested at the top is a victim. The man who has cash at the bottom is a king. In this second part of our journey,
I want you to focus on the what. What makes a business great?
Is it the product? Sometimes. Is it the management? Often. But usually it is the structure of the industry itself. Some industries are just bad. They are competitive, low margin, and capital intensive. I don't care how smart the CEO is. If you put a brilliant manager in a bad business, it is the reputation of the business that stays intact. Avoid the swamps. Stay on the high ground. As we move forward, remember that your goal is not to be active. Your goal is to be right. A few great decisions over a lifetime are all you need to change your family's trajectory for generations. But those decisions require a mind that is clear of the fog of 2026 daily news cycles. Turn off the television. Stop checking the tickers every 5 minutes. The trees grow better when you aren't constantly pulling them up by the roots to see how they are doing. Master the art of the moat, and you will master the art of survival. Now that we've discussed the castle and its moat, we must address the most dangerous element of all, the person standing on the drawbridge. That person is you. You can own the finest businesses in the world. But if your mind is a chaotic mess of psychological triggers, you will find a way to snatch defeat from the jaws of victory. This is where we dive deep into what I call the Lollapalooza Effect. It's not just one mistake that ruins an investor. It's the lethal combination of 5 or 6 mental biases all hitting you at once, creating a tidal wave of irrationality. In the year 2026, the Lollapalooza Effect is being weaponized by technology. Your smartphone is a Skinner box designed to trigger your social proof bias, your envy, and your fear of missing out, all before you've finished your morning coffee. When you see a stock price skyrocketing and you see everyone on your screen bragging about their gains, your brain undergoes a chemical shift. You aren't a rational actor anymore. You are a biological entity being manipulated by ancient evolutionary instincts. The first bias in this lethal cocktail is social proof. We are programmed to follow the herd because, for most of human history, if the tribe was running, you'd better run too if you didn't want to be eaten. But in the stock market, if you are running with the herd, you are usually running off a cliff. By the time an investment becomes a popular conversation at a dinner party, the easy money has already been made. In fact, the popularity of an idea is often inversely correlated with its future returns. Combine social proof with incentive-caused bias. Most of the people giving you financial advice in 2026 are being paid to get you to do something, not to make you rich. A broker makes money when you trade. A journalist makes money when you click a sensational headline. If their incentive is to create activity and your goal is to stay patient, you are at a fundamental crossroads. You must understand the incentives of everyone you listen to. If the person talking to you has a skin in the game that is different from yours, their advice is worse than useless, it is dangerous. Then comes the deprivation superreaction tendency. This is the fancy term for the pain of losing. Humans feel the sting of a loss twice as intensely as the joy of a gain. This causes people to hold on to losing stocks for too long, hoping to get back to even, while they sell their winners too early to lock in a profit. It's like a gardener pulling up the roses and watering the weeds. In 2026, when the market dips, this bias will cause millions of people to panic sell at the exact moment they should be buying. They aren't reacting to the value of the business. They are reacting to the pain in their chest. The Lollapalooza effect reaches its peak when you add authority bias. We are trained from birth to listen to people in suits, people with titles, and people who speak with absolute certainty. But Wall Street is filled with people who are certain and wrong. Just because someone has a PhD or a fancy office doesn't mean they can predict the future. In fact, the more complex the model, the more likely it is to fail when reality hits. I've always preferred the simple wisdom of a man who knows his limits over the complex delusions of a man who thinks he's a god. To fight the Lollapalooza effect, you must develop a checklist. Pilots use them before they take off because they know that human memory and judgment are flawed under pressure. You should have a checklist for every investment. Does this business have a moat? Is the management rational? Am I buying this because I understand it or because I'm afraid of being left behind? If you can't check every box, you walk away. There is no such thing as a missed opportunity in a world with thousands of stocks. The only real mistake is a loss of capital. You must also master the art of patience. In 2026, patience is a superpower because it is so rare. Everyone wants it now. They want the 10-bagger by next Tuesday. But wealth is a slow-cooking process. It requires the liking-loving tendency toward your own process and the disliking-hating tendency toward impulsive action. You have to love the waiting. You have to find joy in the fact that you are doing nothing while the rest of the world is vibrating with anxiety. The 1% understand that the mind is a minefield. They spend more time studying their own mistakes than they do studying the charts. They know that if they can stay rational for 20 years while the rest of the world has 5 or Alt-6 Lollapalooza meltdowns, they will end up with all the money. It's not about being a genius. It's about being the last sane person in the room. As we close this third part, I want you to look at your past financial decisions. Don't look at the outcomes. Look at the process. Were you triggered by envy? Were you following an authority blindly? Were you reacting to a deprivation sting? Identify your patterns. The man who knows his own weaknesses is far safer than the man who thinks he has none. In the next part, we will look at how to build a portfolio that can survive the storms that these psychological meltdowns inevitably create.